Encouraging economic data and a series of unsettling news headlines vied for Wall Street's attention in the third quarter, and ultimately investors were not shaken. The S&P 500 rose 3.96% over 3 months, getting a lift from upbeat manufacturing and consumer confidence readings, as well as earnings news. Away from our shores, the economies of China and the euro area showed improvement, and foreign stock benchmarks rallied along with ours. A slumping dollar offered no big spark for the commodities markets. The residential real estate market looked to be cooling off. The quarter was filled with major news stories, yet the bulls sauntered through the disruptions. Hiring eased during the quarter. The main jobless rate ticked up 4.3% in July to 4.4% in August, while the U6 rate tracking unemployment and underemployment held at 8.6%. Inflation showed definite signs of picking up, or at least nearing the Federal Reserve's 2% target. The Consumer Price Index showed a 12-month advance of 1.7% in July, then 1.9% in August. With personal wages improving annually at a decent 2.5%, did personal spending increase? Not as much as economists hoped. The gain was 0.3% in July and merely 0.1% in August. Few investors thought the Federal Reserve would tinker with interest rates in the third quarter, and it did not. It did announce a strategy to cut its $4.2 trillion balance sheet at its September policy meeting. Beginning in the fourth quarter, the Fed will allow $10 billion in bonds per month to run off, and the pace will accelerate to $20 billion per month in the first quarter of next year, $30 billion per month in the next quarter, etc., till it reaches its monthly goal of $50 billion. Cybercrimes were also conspicuous in the quarter. Credit reporting titan Equifax had its databases hacked, leaving the personal information of more than 140 million Americans at risk. Whole Foods and Sonic also suffered major identity theft breaches. News about the European economy was increasingly positive. By August, euro area joblessness had fallen to 9.1%, an 8-year low. Unemployment was down to a record low of 5.6% in Germany. Euro area consumer confidence rose to a high unseen since prior to the credit crisis as the summer ended. In September, the European Central Bank forecast growth of 2.2% for the region, which could lead the ECB to wind down its long-standing bond buying efforts. The U.S. dollar index weakened by another 2.66% in the third quarter, yet the broad raw materials market did not rally strongly in response, although select futures did. Gold fell after hitting a year-to-date peak in the quarter, its lowest close in more than a month. The yellow metal rose 3.4% in the third quarter. Silver prices increased only 0.3%. Prospective homebuyers looked around, saw fewer homes on the market in the third quarter, along with fewer homes they could actually afford. According to the National Association of Realtors, the median existing home sales price in August was $253,000. By August, the NAR reported that existing home sales had declined in 4 of the last 5 months. The Census Bureau's picture of new homes buying was no better, a 5.5% stumble for new residential sales in July, and a 3.4% dip in August. Between June 29th and September 28th, fixed-rate home loans grew slightly more expensive. The survey showed the following interest rates of 30-year fixed at 3.83%, 15-year fixed 3.13%. Tech shares and small caps outran the blue chips across the summer, but not by much. During a fine quarter for U.S. stocks, the Russell 2000 nearly matched the gain on the NASDAQ, rising 5.33% and taking its year-to-date advance to 9.85%. Investors think of the fourth quarter as a sweet spot for the market, and they can cite history to affirm their belief. Since 1950, the S&P 500 has advanced in 79.1% of fourth quarters. Its average fourth quarter performance from 1950 to 2016 is up 3.9%. Both the Dow and the S&P are entering the quarter on 6-month winning streaks, and bulls seem to be okay with the prospect of a fourth quarter rate hike and a Federal Reserve thinning its bond holdings. Then again, there is no sure thing on Wall Street. As an example, September has long been characterized as a bad month for equities, but that was not the case this year. Confidence is certainly abundant and anticipation is high as the new earnings seasons begin. And if history repeats itself, 2017 will go into the books as a strong year for U.S. equities. That concludes our update for the third quarter. Our next video will be in January. And as always, thank you for placing your trust in Life Plan Financial Group. We hope you enjoy the fall season.